Hello, everybody. Thomas here, looking forward to talking about Apple Computer and applying the Rebel income system analysis to this stock to determine if this might be a good buy under current market conditions, or if it might qualify as more of a sucker's bet. So let's dive straight into it and get into the details. We can see that Apple Computer's been following a very nice upward trend for a couple of years now, and in fact, throughout 2023, has risen from about $130, a little bit below that point, to a high just a little bit below $200 a couple of weeks ago. That is a very clear upward trend that a lot of people would like to consider an overall bullish opportunity. The fact the stock is now down about 8.77% from that high is something that gives a lot of investors the idea that maybe right now there's a good opportunity to maybe buy the dip. Some people who like to focus on value investing might even start to think that if the fundamentals of the company are strong enough, there might be a good value-based opportunity to drop into here. Really quickly, I want to talk about the ideal technical patterns that we tend to want to look for with the Rebel income system. The first one is called a bullish, and I'm just going to call this bull level 1. The idea here is that the 200-day moving average should be generally trending up. If it's a little bit flat, that's okay, but we do want to see a little bit of an upward slope on the up 200-day moving average, which is an indication of the long-term trend. And then as well, like to see the 20-day moving average having sloped down, started to approach the area of the 200-day moving average, also flattening and starting to slope up a bit. At the same time as we see these two moving average kind of starting to converge, under ideal circumstances, the stock's price action will have generally been going down here, but then started to stabilize, consolidate a little bit. And more recently, we want to start to see an increase in buying activity as demonstrated by some upward moving candlesticks. So this is the ideal pattern for a bullish level 1. The other kind of pattern that we like to look for is what we call a bullish level 2. So bull level 2, where again we have a generally flat to upward, slightly upward trending 200-day moving average. The 20-day moving average, the shorter term trend on the other hand, will have dropped below the 200-day moving average pretty sharply, have started to experience some stabilization, and started to turn back up again, started an upward slope. So you start to see a bull formation here. And again, with the similar kind of price action where we would have seen pretty aggressive slide downward with some stabilization, consolidation. More recently, the stock will have kind of hovered and stabilized a little bit, but more recently we should be starting to see an increase in buying activity from the candlesticks on our charts. So these are the two primary patterns that we're trying to look for when we're trying to identify good buying opportunities with the Rebel income system. When I say buying opportunities, I'm really talking about opportunities to sell a put option, generate some income on a stock that looks like it should have more bullish momentum than anything else in the near term. The stock, on the other hand, right now we can see is clearly going up, and in fact has been dropping for the last couple of weeks off of that high. Now, when you see a stock that has its pattern is very clearly the opposite of the two bullish patterns that I just described for you, what we see is the stock is really starting to increase bullish momentum to the point where it's kind of gone parabolic. Now that's exciting and that's a lot of fun to see, especially if you were somebody who bought in at the beginning of the year for Apple Computer. But the more aggressive the slope of this upward trend is, the less sustainable it becomes. And what we're trying to identify are high probability setups as much as we can. So when a trend is this unsustainable, it increases the chance and the likelihood that we're going to see exactly what has happened over the last 3 weeks, where the stock has fallen off. What happens is that up at the top of these big runs is you get what we like to call a supply zone. Now, if you think about this in terms of the simple buying and selling dynamics of the stock market, simple supply and demand. The idea here is that when there are more buyers than sellers, you create demand for the stock. And that's what we saw here in the very, very early stage of 2023, where there were a lot more buyers, and this initial opportunity right here was the opportunity to buy in on that initial surge of buy momentum. This would have been what we call the demand zone. However, the longer that the rally continues, and we can see how this has gone through this year, eventually there are no more buyers. Anybody who wants to buy Apple already has. And that's why one of the things that you see here at the top is initial wave of selling activity. Now, most of the people that have been selling over the last couple of weeks are probably profit takers. The risk of this and the risk of trying to place a trade, buy the stock, make any kind of bullish trade when the stock is in this supply zone, is that any kind of stabilization you may see in this area initially, in many cases, is a little bit of a sucker's bet. And that's because what'll happen is that this initial drop, this will be from people who are simply taking profits from existing positions. Then there might be a little bit of an initial surge back upwards in buying activity as speculators say, okay, this looks like another opportunity to buy the dip and get into the stock. And then what happens is that the rest of the people who have not sold but may be looking at a net profitable position so far will start to sell again. And so you start to get profit takers, then you start to get people starting to panic and wonder what's going to happen next in the stock. Is there going to be something wrong with the company's earnings reports? Whatever the case may be, you'll start to see another increase in selling activity and the stock will continue to drop. So this supply zone creates a very low probability environment for any kind of bullish trading, which is why we generally try to avoid this kind of a pattern. Now, when you see this kind of a pattern, one of the natural next questions that should be asked is where the stock might find its next bottom. Is it going to be around this $179 range, $180, where the stock is at now? Is it going to continue to stabilize and eventually go back up? Maybe, but if it doesn't, is it going to fall all the way down here to the 200-day moving average, which is a little bit above $130? That is also a possibility, but one of the things that I like to do when I'm trying to identify support or resistance levels for stocks within trends is to use Fibonacci retracement lines. And in this case, I've drawn a Fibonacci trend line to connect the low here at the beginning of 2023 with this recent high a couple of weeks ago. And that has given me these Fibonacci lines. The 38.2% retracement line, which is right here, this orange line, is right around $170. This suggests that if selling activity continues in the stock, that it should find its next major support point somewhere in this neighborhood. Now, another interesting technical precept about the way that stocks rise and fall is that within an upward or a downward trend, stocks often retrace at least 50% of those trends. And that's why we have this second line, which is the 50% retracement line, which is around $160. So if the stock doesn't stabilize, if it doesn't find support around $170, the next likely point of support is likely to be around $160. So what we see here is a stock that has probably at least about $10 of downside from its current price right now, and possibly up to about $20 in a very typical scenario. These would all be considered relatively normal retracements of the stock's overall upward trend so far in 2023. Now that tends to negate the idea that the stock might be a good buying opportunity right now. When it comes to Rebel Income, one of the other things that I like to pay a lot of attention to are the company's fundamentals and its value proposition to see if those elements add any other factors that might make thinking about a long-term bullish opportunity in a stock worthwhile. So let's go ahead and take a look at what those measurements tend to be. My fundamentals are pretty straightforward. I like to focus on free cash flow, and I'll show you how I calculate free cash flow yield in a moment. I also pay a lot of attention to cash and liquid assets, to long-term debt, and to the company's profitability and operating margins based on net income to revenue. And another primary filter I apply to all the stocks is that I only work with stocks that pay dividends. Now, I'm not so worried necessarily about the dividend yield, but I do care that they pay a consistent dividend. If you're looking at a stock that does not pay a dividend, you won't see me ever place a trade or highlight it for any purpose for the Rebel Income system. For valuation, I like to focus on two primary points of data. The first is price to book, and the other is price to cash flow. In both cases, it's not just about what those current levels are, but how they relate to historical price to book and historical price to cash flow ratios to see if those set up an opportunity where I might be able to look at something that might be offering a good value opportunity under current market conditions. Okay, let's take a quick look then at those fundamentals. And here we have them. For Apple Computer, this is August 14th, 2023. So as of the close of the market today, the company had reported as of its last earnings statement, a little over 100 billion. Yeah, that's right, 100 billion dollars in free cash flow. Now, the interesting thing about this metric and this number is not just what the size of it is, but also its general pattern over the last year or so. And I like to pay attention to quarter over quarter as well as year over year. It's interesting that on a quarter over quarter basis, we can see this number clearly increasing from about 97.5 billion to almost 101 billion. However, on a trailing 12-month basis, it's a net decline from about 11.4 billion to 101 billion, a little under that level. So some conflicting information there. The free cash flow is a number that I calculate based on the current free cash flow divided by the current stock market cap. And this is more about trying to establish what kind of level that is. I generally like to see a higher free cash flow than normal, but this is really more of just an informational data point to compare with the stocks overall, or excuse me, the company's overall pattern of free cash flow. Cash is also a really important metric for me in the same way that I do with free cash flow. It's not just about the fact that Apple has about $62.5 billion in cash right now, but also that cash over the last quarter has increased from almost 56 billion and from 48 billion over the last year. Now, all of these are interesting free cash flow cash together, but they're most useful when you consider them against the amount of debt that the company tends to work with. And in this case, Apple has about $98 billion. That sounds like a lot. Remember that just about all companies in the market, all publicly traded companies, work with debt in one form or another. And so debt is not categorically bad, but it is about whether or not the company has the ability to service the debt that they have. So they have 98 billion. It's a little bit below the 94.7 billion that we saw a year ago, but a little bit above the level of a quarter ago. That's a little bit of a mixed signal. But the fact is that with $62.5 billion in cash right now and 101 billion in free cash flow, Apple's ability to service their debt is certainly not in question at all. Another element that works in their favor in this case is evaluating their overall operating and profitability, which I like to use by comparing companies' net income over last 12 months and the last quarter to their revenue over the same periods. So here's net income, 94.7 billion compared to about 383.9 billion over the last 12 months, translating to an interesting and generally healthy operating margin of 24.7% nearly. The comparison here using the quarter shows that there is a little bit of narrowing. There is a little bit of deterioration, since in the last quarter, this number dropped just a little bit to 24.3%. So they probably have some increasing costs that are not being completely minimized, and so that means that we're seeing a little bit of a narrowing of their profitability. Still, that is well above 24%, still very healthy. Certainly does not put their debt in any kind of danger of not being paid. This is a company's Apple Computer that does pay a dividend of about 96 cents per share. I'm less concerned, as I mentioned, about the dividend yield than I am about the fact that they pay a dividend. The fact is, there are very few tech stocks in the stock market that actually pay a dividend. So the fact that Apple does is a net positive. Now, the interesting thing about this is that all of this together provides a good overall picture that paints Apple Computer as a fundamentally solid company, but it begs the question of, are they a good value right now? This is where the numbers that we see at the bottom of my spreadsheet become important, because what we can see here is that the fair value target for the stock is at about $115. Now remember, the stock's current price is at about $180. And the discount, where I would actually consider the stock to really be a terrific buy, is around $92. So just based on the difference between the fair value target and the stock's current price, there's about 36% of downside for Apple Computer. This confirms the overall technical pattern where we could see that the overall extended state of the stock's price action over the last year has put it in, or excuse me, throughout 2023, has put it in a position to be at a greater risk of a continued sell-off and continued pullback, drop off of those highs. Let's go back to our stock chart and put some of these valuation numbers in perspective. Along with the basic other elements that I like to analyze on my chart, looking for the basic patterns, I've placed a square on this chart to identify where the stock's fair value target and discount price is, and what that range looks like relative to where the stock is right now. And we can see that just to get to the stock's fair value target, there's a very, very wide distance between the stock's current price and where this is. It's about $65 per share. That's a big drop from about $180 per share. In order to get to where I would consider the stock to be a really, really good bargain, something that I would want to consider using for the Rebel income system, then the stock would have to get all the way down to $92, which means it's got to cover almost $90 of price action. It's got to drop down to this level before that even begins to look attractive to me. So Apple Computer has a lot of fundamental strengths going for it, but it is not a good value. It's not a good buy right now, either on a value-based perspective or based on any kind of technical analysis of what the stock's trend is doing compared to where its best probabilities are. Right now, the likelihood is that Apple Computer is going to continue to drop rather than go up. That means that trying to take a buying trade on Apple Computer right now is a sucker's bet. Thanks for watching. Hope you liked this. If you found this useful, please go ahead and like the video. Please also subscribe to my channel. Hope to talk to you again soon. Thanks.